I am fairly confident they are not reporting cloud revenue in a comparable way. And how do I know that Microsoft's cloud revenue is comparable to Google's or Amazon? I don't think anyone actually does, which is nuts.
StandReady gives you super straight-lined, ratable, predictable revenue. Like, people love ARR, like people love predictability, unless you have to account for variable consideration.
I've gone and pitched to every major revenue operation system and said, is there a way to solve this? And they say no.
Hi, I'm Angela Liu, a former instructor with KPMG's national office, turned product strategist and founder of Gap Savvy. I've closed the books, written the memos, and helped build an ERP from scratch. I'm here with my co-host, Devon, a former controller of Google Cloud. Today, we are diving into how accounting is still catching up to usage and consumption-based models, and how Ivory Tower accounting policies have created diversity in practice that explodes into even more chaos downstream in operations. Let's get into it.
How's it going, Angela? Good to see you.
Hi, Devon. Good to see you as well.
Round two.
Yeah, we get to talk about the infamous topic of usage and consumption-based revenue, the 5-7-year growing accounting issue that has tons of diversity and lots of complications. I'm excited to do this with you.
I'm excited too. Can you actually share how much diversity you've seen through your polls? Because I think that's just something to start this off with. That's just fascinating.
This is a topic where if I just frame out the two main ways that you can be diverse in this, the conundrum kind of comes up when you have a committed type usage that someone is buying. When companies are converting from SaaS, which is that plain vanilla SaaS revenue, take $100K and put it over time, the conversion is to go into consumption, which is closer to what's happening in cloud costs, right? Because they're actually paying for costs in consumption. And instead they're saying, we're going to price in consumption. So instead you get like $120K in credits. You get the same amount of fixed amount, but your commitment, it really is, you only pay for the value that you get. If you're using more or less, you pay more or less. And so it's more aligned to your actual wants and needs. And so the diversity really comes in saying, okay, you've got 100, like, let's say you got 120K in credits, you paid, 100K in, let's say, US dollars to not get complicated in currency. And the question is, do you take that 100K and put it over time ratably? Which would be, almost the same as SaaS accounting with the consumption overage. Or do you take that amount and burn it down as the actual consumption goes? So I'm going to put those in two categories, which is you've got consumption-based selling model, but you can either take that ratably with what we call variable consideration, meaning if I have an overage or an underage, you just take it ratably, but any overage, you then would need to estimate for that overage and also smooth that out ratably over time. As opposed to just saying, okay, we've got 120 carrying credits, and as you use this thing, we'll take down 30 this month, 40 this month, however much is, and revenue turns out looking like actual consumption. Those are the two main camps of diversity that you can end up in. And what I've seen over time as more and more SaaS companies adopt this model, which is very advantageous both from a selling story perspective and cost margin perspective, is that a lot of companies got stuck in this ultra technical accounting conclusion that says this overall economic selling model is no different than a SaaS selling model, meaning as a company, I just have to keep the lights on and keep delivering over time. I need to keep the lights on, and therefore it's more of a straight line model, which means that I'm going to do okay, I've got, the 100K and I'm going to take that ratably over time. Usually we get 30% overages, so I'm going to tack on an extra 30 that I'm not actually going to invoice for and smooth that out over revenue, which sounds cool, except for obviously you're going to be wrong a whole bunch, because how can you possibly know exactly how much overage? Versus what feels like a little bit of a cleaner model sometimes, which is, okay, let's just track the consumption and recognize that as revenue. Most companies, maybe 5 years ago, I would say started out in that ultra technical accounting loophole as companies have reported their financials. Clearly, you're seeing more and more cumulative catch-ups, more and more cases where you're slightly wrong, more and more cases where you've had to do a portfolio approach, and that causes their auditors to really think, was that the best model? Was there something in here that I missed? Should I have considered consumption more? So it's been really interesting, whereas I would say more than 50% of companies were doing it ratably before, and I've been seeing more and more companies flip over to a consumption type model, especially if they're in that infrastructure part of the stack in terms of the product they sell.
Yeah, I think.
What about you? I'm so curious what you're seeing.
Yeah, so I think you nailed it. It was a great overview. I'm going to layer in some perspective on Like, what was the whole reason that companies are making this change? I think you alluded to it a bit about the cloud costs. But there's a whole broader change. Because I was just working on a McKinsey recommendation for a go-to-market motion for a major public company about how do we revamp our model in order to be more consumption-based, more consumption-driven, advertise it as a platform, and structure it so it would be ratable without triggering what you just said, like cumulative catch-ups, all those risks. And the big takeaway, what's interesting in the McKinsey report was, hey, this is like an evolution from on-premise software to subscription software. This is the next evolution of subscription software. And the reason from it that a lot of people are missing is it's not just cloud consumption. It's also that a lot of these companies have built out multiple different subscription models that work well together in an ecosystem, but then customers don't use. So a good example was everyone used Adobe PDF, right? But Adobe made all this other great Photoshop and great video editors that no one was using. So they said, hey, we want to expose other people to it, and they're overpaying for the Adobe PDF subscription. So instead, what if we package that in a platform with all this other work, and then we could expose them to the whole ecosystem, and then people who are overusing, under leveraging the platform currently can pay for what they actually are entitled to. They can go around and bounce around and try out all these products and get more value. And then customers who abuse the subscription model, where they're just buying these subscriptions and way over consuming, we can actually charge them what it was worth. So you're not subsidizing your big customers anymore. You're actually extracting value from the big customers because they can pay for it. And you're giving real value to small customers as they grow. And so it's actually kind of a beautiful business perspective. It sounds really uncomfortable. Most people go, ew, consumption, but it actually has a benefit to smaller users. And it kind of penalizes bigger users a little bit, but those bigger users are corporations that can generally pay for it. So understanding that overall, then he goes like, well, how do we account for that? That's a massive business change. And I don't think most people recognize what a significant change in a value proposition that is to a customer. And then you got to go and, well, what's the performance obligation here? Is it actually one performance obligation of this platform? Or are we selling a variety of different services that are fulfilled independently as parts of that platform? And so that's where I get stuck normally first is it differs. We can't just, I love that people put it bucket A and bucket B because that's the 606 assessment, like that's how the assessment kind of lands in the diversity of practices. But there's a huge spectrum. It really could be a company might have 90% of their product packaged as, hey, we're standing ready and these are all time-based products. Or you might have a company who's selling everything that's completely tied to cloud consumption-based usage. And you could have a business model that's very heavily driven on overages, or a model that's very highly driven on right-sizing packages on day one, where you never expect overages and might not have a business practice of ever charging for overages. All of that really depends here. And we could hash it all out of like how that would all be framed, but that's where my mind goes initially.
Yeah, I think that is so interesting when you say like that shift in mindset in selling, which that's kind of what I call that selling story that is so, I want to say irresistible of moving to this model. Because there's like, if I was a salesperson and I saw all of my competitor companies that were selling to the same customers move to this model, I would think to be competitive, I also need to be able to say that same story where I am pricing and packaging in a way where I'm able to articulate an X amount of fixed fee for the platform for me to just stay running. These things that you might not want, but I really hope you find out you do want, that I can give you a deal that shows you its value. What I think is interesting to also slot into that selling mindset is the very real cost side of that. Because when most companies have an insanely difficult, or basically it's impossible to really understand margin. And I do think that was a shift from when all these software companies moved from perpetual, right? Because perpetual software, cost-wise, was basically free, right? It was like a 99% margin. You shipped out that CD, or like there was a point when Oracle was sold on a CD.
That is insane.
Right? Like, and you were done. No one was developing that thing. You might have had a little bit of PCS, but like your cost was done. Versus today, if you're selling or if you've built your software in the cloud, every time that service is accessed, every time specific functionality, depending on how efficiently you've built those features, they hit different parts of AWS, GCP, Azure, and each of those pings cost you something depending on its geography, depending on its all of those different features cost a different amount. And so it's interesting because you get both sides, which is you're able to give a really, really strong value proposition. And in addition, you're also able to, hopefully, if you can quantify it, and this is where systems get really, really hard, in theory, if you had enough data and you could understand the relationships of how you're pricing and packaging and how that cost translates to your cloud costs, you would be able to sell more effectively and be able to understand in your, PDF download example, how much does a PDF download actually cost me when that's processed in the cloud, and am I pricing it appropriately? So I think that's an interesting dynamic, both in what the selling model proposition against the profit margin proposition, against this very real shift from perpetual, where we used to not care about costs at all. But cloud isn't free.
Yeah, well,
right?
wait, you got to pause there,
Perpetual's
'cause
free.
that's why I love talking to you about this stuff. I never thought about it's so true. We always got to go back to first principles. And one of the basic principles is the matching principle. Like, hey, our expense profile should somewhat match the revenue it's generating. And to your point, I've worked and advised for tons of great companies. No one has that level of detail. It is really, really challenging to figure out how does this cloud cost and these customer costs and our support costs and all of this translate to your specific product. And we study all this in college, but in practice, you don't get reporting at that level. It's really challenging. But if we did have it, it would actually help the conclusion quite a bit. Good call.
Yeah. It's this breed that doesn't totally exist yet, but kind of exists. And it's this, I think there's a FinOps practice that kind of does this, but it's really your traditional cost accountant. I don't know if you've met or know a lot of cost accountants, but that is a meticulous practice. Like FIFO, LIFO, layers of inventory, understanding down to the detail what your margin is. And that's what manufacturing was. It was a detailed depth of understanding of your margin at every phase of manufacturing. And it was optimized to an extent where you always knew where your margins were. Cloud is very different, partly because the pricing model is quite complicated, as we talked about in the last episode we did, but also there are so many things you can charge for. So however creative a cloud provider gets in terms of, it hits this server in New Zealand and these types of transfers cost this much, except for during this time of day, right? You have all of these different variables that go into cost that make it significantly harder to understand that margin. I wanted to bring that up because I wish more people would think of the very real part of that, because when you look at ASC 606 and the way that this particular accounting conclusion ping-pongs in the standard, we almost never talk about cost because no one can see it. It's not that we don't want to see it, because operationally that would be amazing. It's that no one has it today.
Yeah.
And that's partly because even billing for these consumption models is so difficult. How could you possibly, from your vendors, get that billing data to build out this margin?
Yeah, and I think it's an excellent challenge you've addressed too here and an opportunity. These software companies and advertising companies or whatever they may be, they weren't manufacturing backgrounds. So we're really bridging these large companies that went from on-premise not too long ago and had no cost management. Maybe they worry about some R&D or their engineering teams, but that's about it. It's really more like selling and administrative expenses. And now they're migrating to what really is more like a manufacturing business, where they really should be cost-centric, but they aren't. And there's none of this rigor or discipline. And wow, I would love to see a company who brought in a manufacturing level cost accountant who could tell you how much each bag of Doritos costs when they're making 10 million. A traditional software accountant who's just expenses. That goes below profit. It really needs to be enhanced.
Yeah. And not biased, and I don't know if we'll keep this in, but that is a startup that we're both tangentially working with. That was the thought process, is this is the number one cost for most cloud companies, especially in that phase before they start selling. Every engineer, every FP&A department is actually thinking about this specific thing. Somehow that rigor and full-blown discipline has not creeped that far into the accounting world, but for some reason it's in the engineering world, right? Engineers get scrutinized for how efficiently they build a feature. But we don't see that necessarily, and the most it creeps up in our world is in FP&A with a slight connection to cloud costs. And then if I bridge back again to our accounting standard and our technical ivory tower world of how do you navigate through these words to decide if you're stand ready, which means I'm just keeping the lights on because that's the standard way that we sold things in software converted to kind of our traditional cloud world, versus those are the big two decision points. Am I stand ready, delivering over time, flat, I just keep the lights on? Or am I really selling specified features, specified services, or options, right? Every time I click on this thing and download this thing or transfer this data or do this elastic search or ping this, right? I'm obviously not from that technical background, but I've seen enough words over and over again to be like, oh, this gets complicated. It's not like a price times quantity calc anymore. It's like a price times quantity type of feature. Like there's so many variables in this calculation, at least from the cost side. But we don't think about that when we're determining the accounting conclusion to say, is this a specified service or option? Because pricing hasn't caught up to it yet. Not every company has been able to price like that. They might want to, but it's much easier to sell to say, look, you've been buying this as a cloud product for the last 3 years from us. We're going to make this feel really good and still straight line because you already know the value of the platform that I give you, even though, of course, I had to build that platform on specific features and services that that platform provides. You're used to paying for it fixed straight line. So I'm going to get as much money out of you continuing that. And for these extra features that you maybe didn't want, but you might find really useful, let's do this on a usage so that you can feel like you're getting the best deal and I can understand and track your usage. We can start quantifying what customers are using certain features more and actually costing us more. The consumption piece might start out small and then might grow. So if I'm a pure application company, like you said, Adobe, and it's like downloading PDFs, that is a very business user feature where I understand what it means to download a PDF versus if I was in infrastructure middle of the stack, like an Elastic or New Relic or like a Snowflake, where I sit right on top of the cloud before all the applications get built on top, where I know I have to price a little bit more consumption-y. It's clear that what I've built and the cost for me is directly related to that, where let's say 90% of your revenue is consumption, and it always has been, you might more easily fall into I'm not selling stand ready, I'm doing specified options. Cool, let's do consumption-based accounting, let's go down that path. And then it gets more and more gray in your Adobe example, right? Where it's like, ooh, what is a PDF download? What are all the features and all the costs that actually went into that? That's more business application. And then I think you're like, is it more straight line? Is it more option? And I think that's a really interesting break point because in accounting, we don't always talk about the type of company, the type of technology that it is, even though I think we are roundabout way getting there by saying something like 90% of our revenue is consumption, so we're more likely consumption. Or, I'm DocuSign. We've always sold it. And I'm not saying specific details. It's just that these are technologies that I think we've all interacted with so we can understand a little bit more. Where it's like, I'm used to paying X amount per year for this thing. And if you suddenly start charging me for every time I sign a doc, I might get a little mad. I might not be ready to move to more consumption in some places because I'm not used to it as a consumer. Versus other places where it's like, I've always been paying pay as you go. Of course, when I get into a commit, makes sense that I would have a commit for a year of X amount based on how much I think I'm going to use, plus or minus overage.
Okay, so you're nailing it and exactly what I think. I hope everyone realizes the levels of complexity to this topic. And, we'll talk about systems probably in another video because we just could use all this time just to talk about technical accounting. But like what you just said, it makes me think about going back to kind of the basics of identifying a performance obligation. Like, hey, is this capable of being distinct? And is it distinct in the context of a contract? And it gets really challenging when you are already selling products on a subscription basis. Let's say you have 5 different products on a subscription basis, and then you're saying, hey, we're going to move these over to a platform. And this platform is different than these 5 subscription items, even though it's comprised of all 5 of those subscriptions. Because obviously each of those items are capable of being distinct because you have sold them separately. So then the question is, are they distinct in the context of the contract? And it really then goes back to your pricing teams and your business teams. Like, are you delivering those subscriptions? Are you performing an obligation there? Or are you providing a platform that customers can get unlimited access to whatever they want? And then how are they pricing it? Is like each subscription, now you're figuring out a minimum commitment fee for a year that ties to all the subscription fees, and then you're giving a proportion of licenses or credits that facilitate it. In my mind, first you need to make sure you actually have a new platform. You can't just, if you want to get, let's say you, in theory, a company wanted to get away from consumption-based accounting. First, like you can't just keep your separate subscriptions and call them something different. You need to bundle them in a way to have a platform that you're actually standing ready to provide these services, and the customers can access them directly. So you actually need a digital transformation effort. It needs to go beyond that, where you also need to allow for unlimited overages. Like the customer should have access to buy more that they want. And you also need to right size it in a way that you aren't triggering overages off it. To your point of the variable consideration, like when you're selling a customer a package, there should actually be a business case that, hey, if a customer is trending towards an overage, we figure out how to upsell them to the next level of the package or some kind of operational process. So the idea is, hey, this is really for you we priced you to get whatever you want. And our job is to stand here and support you in providing those services rather than to nickel and dime you every cent of the way. And so then you get this interesting question of like, hey, if you could look at data of a customer of how often are customers triggering overages? Because if you're triggering overages all the time, maybe that's an indication that it goes back that you haven't identified your performance obligations correctly, which is scary because then like your 606 policies are intrinsically wrong, right? And then, yeah, it gets really wonky really fast. And so that's why I feel like accountants need to go more and more upstream. But sorry, a little bit of a tangent there.
No, a perfect tangent, because I think it actually speaks to why there's so much diversity in practice. Because the underlying technology is similar or the same,
yeah.
Right? Then you get into selling model, and then you get into customer expectation. And if you are trying to get into stand ready, and let's talk quickly about why you'd want to get into stand ready. Like stand ready gives you super straight-lined, ratable, predictable revenue. Like people love ARR.
Yeah.
Like people love predictability. It prices really well on the market. It's like, if you tell me what's going to happen, I'll feel good about my life and you'll price higher.
Easier to account for, easier to audit. It's just like, man, it makes accounting life a lot better.
Yeah. Unless you have to account for variable consideration.
Yep.
Which is the worst thing in the world, right? Because variable consideration means I think most of the time I'll have overages of the 30%. Of course, that you're going to be wrong because you don't have a crystal ball, but you'll be right as much as you can be, but always a little wrong. That's just how estimates work. I think what you're saying is try to right size it perfectly, which is also going to be difficult because if you could do that, like I almost think sometimes because when you're auditing, should there be variable consideration not, or what is that variable consideration number is? It's like, oh, you're going to go through and ask all of your salespeople to talk to all of their clients and like, or all their customers and see how they're doing as business. Like if I had to estimate how every tech company in the world was going to do this year,
yeah,
like that would be a terrible model. Like, I don't know how Databricks is going to perform, because I'd be rich, like, right?
Yeah.
I don't know if their customer base is going to have more or less usage that their product is built on mine. Like that would be amazing. But I'm obviously wrong. And so there are degrees of right that you can get to, and I'm not trying to blow accounting out of the water, but there is this danger in when we get to these theoretical estimates. Like I totally conceptually understand the theoretical argument of if you most of the time get a 30% overage before you modify, then you should probably recognize 30%. But the reality is also what you said is usually the sales tactic is I will price my overage slightly higher than my list price, or in a way, or slightly higher than your contract price. But I'm going to price it so that you are incentivized that instead of paying that overage, you come back to the table in that 9th month when you go over. And when you come back to the table, I'll give you an even better package, maybe a slightly lower unit price, but that is going to overall increase the amount of money I am going to get from you.
Yeah.
And I say that very specifically because in accounting, we have this concept of allocation objective, right? And there's a lot of debate of, is the change of the price or the tiers or blah, 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 like, does that throw you out of the water and you definitely have variable consideration? But if you think about like any normal human being that is selling, like you're going to get into a contract that is going to incentivize, in general, more money being made.
Yeah.
Right?
Yeah, exactly. It's like
So-
variable consideration versus contract modification is what
Yeah.
a discussion. There's a lot of ambiguity there.
Right, because when you get into what the accounting really looks like, it's like, I had that 30% variable consideration, and what do I do with it when it doesn't happen, doesn't come to fruition in actual invoicing because I didn't upsell instead? It's a very real scenario because that would be a successful company, right? Like, I would rather have my customer come back to the table, negotiate a lower per unit price and a higher overall contract price, because if they did overages, they're using my product. That's awesome.
Yeah, exactly.
Right? And yeah. And so, like, I just think that world of expected modification and what you do in that scenario, which I think in accounting, and even this is debatable, but I'm just going to throw out where I feel like most companies have landed eventually. And I've argued both sides, so I feel bad about this sometimes, but I've definitely argued both sides. Where you take what you don't recognize. So let's say you were recognizing this 30% over time because you said you had variable consideration. They do a modification, they do an upsell. What do you do with that difference? Do you cum catch and like cum catch down because you ended a new old contract and begin anew?
Yeah.
Or do you take that difference and you roll it into the new, so you smooth it over the future? Which is really like, okay, I made a whole bunch of estimates. I was wrong or right in one direction or the other, because you're going to be wrong. It's just normal. And then what does that difference relate to? Does it relate to the future or does it relate to the past? And I would always argue it relates to the future, because you negotiated this thing based on their continuing use of your product. Even that, I know I'm saying it very lightly, and to actually work through the words of the standard is artwork.
Yeah, that's true.
But like, I always try to simplify it in like, is what happened on this day related to the future or the past? And then you still get that kind of smoothing of that revenue. But I do think that is a big general issue with that model of everyone wants to get ratable. But if you get ratable, there's the danger of variable consideration. If you do variable consideration, is it really variable consideration, or do you do a modification? If you do it on modification, do you do it forward or back?
Yeah, exactly.
On, right? It's just like, what? Like, draw me a decision tree. And you're like, I don't know if I can, because it's split up in like 5 different steps in the standard, which spans a 1,000-page book. And like, someone artfully needs to put this, like, it's wild.
Yeah. Well, and then it did add one layer of complexity there, because then when you're going the future, when you want to go that future path, everyone feels good about it at first. They're like, yeah, that makes sense. We're going first. Then 5 years down the road, they're like, oh, crap. We have like millions of dollars accumulated for futures we're doing a contract modification every 9 months. What are we doing? The
So glad you brought
downstream,
that
you
up.
don't know what the future is going to be of the models, right? No one, so it's nuts. Yeah.
Well, this is the problem with the artwork of Ivory Tower accounting, right? Because everyone feels good about it until 5 years later, which I love that you said that. I always call this that daisy chain effect, where you're like, after the entire accounting team leaves,
Yeah, exactly.
someone's stuck with this weird accumulated balance that they're like, I don't know, just roll forward.
There's always that deferred, like,
And
do
then
we
you're
want
just
to
like,
open
oh,
that
it's
up?
acquired. And you're like, I don't know how to solve world peace there, but I'm so glad you brought it up. Drives me nuts because, again, it's that clash between Ivory Tower technical accounting and like, I can totally understand the concept. But at some point, like you said, that basics of accounting, first principles, like, there's sometimes I'm just like, can we get cash?
Yeah.
What was that? The thing that saved us from this before was the SEC had contingent revenue cap. I'm sure people thought about this, and then that whole group of humans left, and then we forgot about it, and then we're like, oh, this is a great idea. But contingent revenue cap under 605 basically said, if you can't bill for it, you can't recognize it as revenue, which was like fairly simple. And then they're like, no, but you're delivering value.
Yeah.
And so
but it
sometimes
goes
I'm
away
like-
this whole variable consideration discussion.
Things when 606 came out,
Yeah.
right?
Well, so here's what's crazy to me, right? I believe this is a big problem because one of the foundational principles is comparability of financial statements. And I believe that if you look at Amazon, you look at Microsoft, and you look at Google, I am fairly confident they are not reporting cloud revenue in a comparable way. And you cannot read in their footnotes disclosures and figure it out for the life of you because of the diversity of practice here. Like, one might be having variable consideration, like you said, and be recognizing it on top of their cloud fees. Another one might not be recognizing variable consideration, might be recognizing like more consumption based, another might be having a ratable portion. And you just get a generic footnote of something like our consumption based revenue is recognized on a consumption basis. Our subscription based revenue is recognized on a subscription basis. And our on-premise we have some obligations where we are stand ready. And you're like, how do I know that Microsoft's revenue is comparable, cloud revenue is comparable to Google's or Amazon's? I don't think anyone actually does, which is nuts. Like if you think about it, that's insane.
I assumed they were doing, at least from the cloud product, I assumed it was all consumption. But what you said scares me because that's true. They do have a subscription line. And what's in that? Because it's built on their cloud in the same way. All of those companies are clearly the masters they're the first people that priced in consumption, right? They're what everyone else is built off of. So it's interesting that I actually just made an assumption, like without having gone deep into any of those financials, that they were all consumption based. And the fact that that is not totally clear is actually interesting. Yeah. Like I didn't think any of them were doing this straight line variable consideration thing, only because they were so deep in the stack.
Yeah.
The first layer of any cloud product built is the cloud provider. So AWS, GCP, Azure, right? And every other cloud company in technology is basically built on those three, unless they have their own. And so I assumed that they were the most consumption-y of the consumption.
Yeah, which I think is a fair assumption. And then the question is, what are they actually doing? And what have they actually disclosed? And the honest answer is the footnotes, because these companies are so large, are just not detailed enough to understand if these companies are reporting comparably, because they have different auditors and they have different ways of interpreting the same fact set. A decision on the decision tree, one way or the other, could decide if you are grossing up your revenue in order to recognize the reverse breakage variable consideration or not. And so then that also impacts your remaining performance obligation disclosure and your backlog number. And are backlog numbers comparable? That's a good question too, right? And I don't know if anyone's actually done that diligence or work, and how can you justify the difference in prices for these companies? Like it kind of relates the whole concept of accounting.
Yeah, there's a huge can of worms on like accounting comparability, and you hope that that's what the SEC is there for. But you're right, at a materiality perspective, you can't tell. And these companies are so huge that there are products that probably sit higher in the stack, like an application, that you could get into that counting argument. And there's different orgs and there's different conclusions, and then that has to be just exacerbated on every company that builds on top of them. So because how is that going to come through for the next company? It's going to come through as a bill, right? And sometimes it's just going to be an annual subscription. It's just going to be an invoice that I get. And sometimes it's going to be, here's your consumption for the month. I mean, people have such a hard time reconciling that anyways, just in terms of cloud costs. But that's really interesting that you think that there's a risk, or that there's a solid risk in those not being comparable.
I put it on the channel. I'll pay someone $100 today. First person to prove me wrong. But I bet you that those are not comparable. And like you said, you had that company level materiality, but then most of the value of the companies, like from a price standpoint, is driven by the growth of their cloud departments. That's like the whole future, and their AI departments, which all might have different interpretations of the guidance. But I don't know. Sorry, can of worms, another tangent.
No, it makes me want to bring back that contingent revenue cap, because
yeah, me too.
I think to some extent you can't force the world in articulating and disclosing all of those nitty-gritty details of getting to the standard. But if you could say, I can't bill for it, everyone understands that, and so I can't recognize it until I can bill for it, it might be a little crude in terms of like, well, you didn't really show the theoretical value that you delivered, that you might in the future get in terms of money, which is a cute concept.
Yeah, exactly.
Is comparability more important than theoretical?
Well, it's like you said it kind of jokingly. Why not go back to a cash basis? And yeah, obviously not that extreme. There's a value to figuring out what's earned versus what's incurred.
Yeah.
And how the cash flow works. But we've gone a little far. You are making guesstimates on what you're going to get on some of these are 10-year contracts, 10-year multi-billion-dollar contracts for some of these companies. And you have to guess what you're going to collect over the next year and make an estimate on revenue recognition. That's insane. And so can we ground it a bit in what's actually happening so we don't have to make such outlandish estimates? But
yeah, I think that is like, who does it serve? I think is the overall question in that space. Something else that I wanted to address, which was the RPO, the remaining performance obligation, and the disclosure tail. And so it's interesting because when the new standard got adopted, which I guess is not that new anymore, that's that same thing, which is like, what is part of your contract? What is that tail? And I think people are really paying more and more attention to that RPO number, especially when you have consumption-based revenue, because they're trying to see like how much is left in the pipe. And so, yes, that first conclusion may or may not be consistent. But let's say over time, more people move into consumption, which would, in theory, slightly decrease part of the estimate. And the reason why I say part of the estimate is because even when you're in consumption, like, 'cause I used to think that, like, I go back and forth. Sometimes I'm like, oh, consumption-based revenue is way better because you don't have to estimate variable consideration. But then I realized that even if you go into consumption-based revenue, you have to estimate breakage.
yeah,
Which
exactly.
means that, like, in that decision tree, right, I've decided that the nature of my performance obligation is a individual service or an option instead of a stand ready. And so I am going to recognize revenue as consumed with an idea of breakage, meaning if they don't consume all of it, I can't recognize that amount, which actually turns out to look a lot like the same estimate on variable consideration.
Yeah.
Because you're still forecasting out how is my customer going to perform on a contract-to-contract basis so that I can take down the revenue at the appropriate amount or a per unit as consumption is taken, right? There's still a whole bunch of estimates. I think about that, like, because most of this consumption it's either on a tier price basis or will be on a tier price basis, right? If you're not on it today, eventually someone will be like, oh, we should tier this thing so that as someone uses more, they pay less per unit. And then you get into the question of what's the unit and how do you take down consumption? And the only way that you can get to that, yes, material rights. Yeah. So I'm so glad you said that word. That's what, yeah. Because that, like, what is the value of your material right, which is your right to purchase another theoretical concept that you have not invoiced for or will not invoice for.
Yeah.
This is where, like, we've obviously both gone deep into accounting, and so we believe in the conceptual nature of the economic value. But sometimes we get so disconnected from the actual invoice that, like, you're building on assumptions on top of assumptions, and, like, nobody cares what material right is. I mean, like, we care, but we don't really care, because when in those 5 years of daisy chaining, or 10 years in your example, when are we going to get back to how much money did I actually get?
Yeah, you nailed it. And I want to bring this, because it'll be great for our next talk on the systems. But that's where, like, for me, I'm more generally aligned too with consumption-based if you have any semblance of overages ever planned, right? It seems like a better. But then you get this really big challenge of, okay, what if you have 10 consumption-based performance obligations in a platform? That's not abnormal, right?
Totally normal.
It could be, and I've seen companies that have 1,000, right? Yep. Well, then how do you do SSP allocation for that? Because you actually have to make an estimate on day one of what you expect to sell for, like, let's say you have a minimum commitment of $1 million. How is that comprised of every single performance obligation? Only way to do that is to make an estimate based off historicals or based off some customer forward-looking estimate. And that's going to be wrong. So, like, if you think you can't get variable consideration right, which is your estimate, how the heck are you going to get your estimate of independent sales in order to figure out your SSP allocations? And if you have more than one FSLI, you're going to have allocation swings, or you're going to have, if you have, like, different point in time recognition or really wildly different pricing mechanisms, going back to your pricing discussion, you're going to have huge timing swings, and you're going to have to do a quarterly review of your estimate versus actuals on your performance obligation level, which is insane. Maybe Everest can do it, but no other system I've ever seen can operationalize it. In some of my jobs, I've gone and pitched to every single major revenue operation system and said, is there a way to solve this? And they say, no, it's not possible to systematize this. You'll have to do some conventions or manual recognition, which has its own risk to it. So kind of screwed if you do, screwed if you don't, you know? And to me, the lesser of the evils really winds up being ratable most of the time, but then you have real issue of the business really has to structure it in the right way, or else then you can have really big swings in revenue recognition also. So yeah, not enough people are focused on this, but that's my rant. Yep.
Yeah, it is a solid rant. I think it's a good cliffhanger because the systems, we just talked about this I call this the technical accounting conundrum of usage-based, consumption-based revenue, which I absolutely think it is. Then is exacerbated into the systems-based one, which has a whole slew of other actual technical stringing together of systems, transforming data, and then the estimates. I always think, I know we'll do an episode on this and maybe it's partly, but I think that there is a huge hope in how AI can be applied here because human beings are actually not good at chugging a ton of data and accountants aren't equipped often to be able to run large ML models or large forecasting models or to be able to understand in large quantities and very quickly different trends. But I think that that's where there is some hope. And I know a lot of people call AI a black box, but I actually find it to be quite nice that I can always ask for the rationalization step by step. I can always ask it to audit its own work to create something. And that is way less black box to me. So if we are to do these estimates, whether it's for material right, for breakage, if in the consumption world, or whether it's for variable consideration on the other world, how can we, one, create our overall system architecture, which we should talk about, and that's very, very difficult and very expensive, and there is no silver bullet right now. And then on top of that, how do you then take that data and every single month or quarter do a reliable estimate with some sort of auditable backing?
Yeah.
And that I feel like I don't know how many startups are working on this right now. I feel like there's a ton, right? Like this is a very expensive problem for a reason, but I hope that by more accountants throwing their hat in the ring and articulating and combining with some of the engineering brains in the room that actually have to create all the events and understand the system side a little bit more, that those worlds can come together because this pricing model is not going away, right? It's just how do we, together as an accounting community, together as a technology community, how do we solve for this so that we can actually see what's happening? And I do think we have tools in place and that gives us some hope.
I love it. I couldn't have said it better myself. I think it's a great way to end today, and 100% with you. And just to say, I guess my only add-on there is I have seen $10 million plus design efforts to fix systems like this. And like you said, they aren't auditable and they never get executed. And so it's going to be, I'm looking forward to hearing your level of expertise on this because you've done the homegrown, building your own ERP kind of from scratch. I'm really excited to have that conversation with you next week.